Good morning. We all know we all know the importance of inclusion of people. However, we also all know how difficult it is in rural areas to provide services to young people, where low population density, poor infrastructure is caused by youth financial inexperience, innovation, that will help to these issues to provide financial services to young farmers, students, and entrepreneurs. Um, my name is Tim Nurse, and I'm the president of Insights International. I'm pleased to welcome you here today. This webinar. This event marks the first and many of us and also a good starting point for our event. First is making senses collaborating practitioners, academics, private sector actors on how to expand. We provide like this webinar, as well as curated information on the Youth Economic Opportunities. We host a global learning summit on an annual basis, the Global Youth Economic Opportunity Summit. The other sponsors are TI's Global Free Movement. Joined by over 250 people who registered for the event online. For the webinar participants, we welcome your questions and contributions throughout this virtual learning event. Please write them into the chat box on the bottom lower left corner of your screen, and the moderator will be following them and pick from them during the Q&A session. We also welcome your tweeting and Facebook posts using the hashtag YouthEO. So to begin the event, I'd like to hand over the mic to Paul Nelson. Paul is the Digital Finance Advisor for USAID's Global Development Lab, and is going to talk to us about some of the larger trends that we're seeing in this space. Paul?
I can figure out a way to control the slides, then I would. Great. All right. So we'll move to the PDF. Well, everyone, thanks for having me. My name is Paul Nelson. I work on the digital finance team, and you can move on to the next slide there. So just to get us started, basically the team that I sit on, our focus is on fintech, digital finance. So it's primarily looking at opportunities that technology poses to accomplish development objectives that we as an agency have. And at a country level, we basically look at market-facing opportunities in 3 dimensions. Number one, the ability that the USAID presence in the field can have on the enabling environment, working with policymakers and regulators to lay the groundwork for an inclusive financial sector. Working with private sector partners to make sure that they're in a position to see the business case in investing in more inclusive financial services and understand better how they can design products that reflect the actual needs of consumers and merchants on the ground. And then lastly, on demand, how can we bring people along on their journey as a customer, as a consumer, as a merchant. Digitally delivered financial products and use them effectively. Number two, we encourage institutions, including many of USAID's implementing partners, to digitize their institutional payment flows, because we see this as an opportunity, number one, to improve efficiency and transparency and accountability within those institutions by shifting away from manual-based processes to digital ones that can be more effectively managed, but then also in doing so, to foster more demand for those financial services, and thus build a business case for the private sector to invest in those services. And the form that has taken, as many in this room may be familiar with, is the Better Than Cash Alliance, which is housed at the UN Capital Development Fund. And they primarily work with governments to obtain policy-level commitments to digitize payment streams. And then finally, number three, we as a team look for opportunities within USAID's development footprint and the host country priorities that are present on the ground, to use fintech and digital finance as a means to development ends in other sectors. So we have significant investments in health, in agriculture, in energy, in governance, and we look at how fintech can be a driver of objectives in those sectors. And then lastly, as some may as well be aware of, we recognize that this is a fast evolving field. Technology has really taken off in the last 10 years. There are a lot of lessons to be learned about how donors can act effectively in this space in the best interests of the people that we care about. And so we work on building the capacity of our agency colleagues around the world, and then also working with implementing partners to make sure that we're all spending our development funds as effectively as possible. So setting the scene. Basically, as everyone here, I think, already knows, and talking to the choir, see the imperative for financial inclusion based on all the access gaps that still persist, even with the advent of technology, even with the mobile revolution that is taking place right now. In particular, at the top, you can see 39% of young adults do not have an account at a formal financial institution in low and middle income countries. 54% of adults save, but only 23% do so formally. Likewise, many people would have difficult or impossible time accessing funds in an emergency, which is an issue that happens to be present in the United States as well. And then, of course, on the government side, many recipients of government transfers and social cash transfer programs, social protection programs, have to rely on receiving those funds in cash, which presents its own set of issues. Next slide. And of course, given where I sit in the agency, we are very cognizant of the opportunity posed by really two things. Number one, the increasing ubiquity of digital technology, primarily in the form of the mobile phone, but not only that. And then number two, different business models that policymakers and regulators are permitting for delivering financial services, primarily outside of bank branches. Of course, branchless banking, relying on agent networks is a big opportunity that I'm sure we'll talk a lot about today. Next slide. So I think one thing to recognize and acknowledge is that the opportunity that we are aware of does not just happen. It requires some nudging on the part of us as a donor and some acknowledgement of the fact that these ecosystems don't just occur on their own. They require persistent efforts on the part of many actors. As far as what we as an agency would aim for, you can see there, it's really enabled, number one, by a sound policy and regulatory environment, where the policymakers are really seeing the value of the technology in different ways of providing financial services, and developing the frameworks within which providers can come and consumers can access those services effectively. Number two, and this is more specific to digital finance, the digital finance market or ecosystem in which many players are able to offer a range of financial services that are meeting the needs of consumers on the ground. So we really care about competition, number one, so it's not just a matter of banks providing a service or telecoms providing a service, and also consumer protection, but also services that are not just credit, they're not just payments, not just savings products, but the basket of services people need. And then naturally, at the last bullet there, all this depends on a robust infrastructure, both in the form of agent networks in communities where people live and work, but also technological infrastructure where there's no network signal. It's difficult for people to leverage the potential posed by mobile phones, or for regulators and policymakers to oversee the market. Next slide. So how can we, as an agency and donor community, provide ways to grow that ecosystem and overcome other barriers to financial inclusion? Just to highlight too, going to the purpose of today's discussion, and these two, I think, have certain tie-ins as well to how you can effectively grow a vibrant digital finance ecosystem. Number one, market facilitation or market systems development. I think we see great value in recognizing that no single actor is able to overcome the whole host of challenges and barriers that lead to a situation where exclusion persists. And here it's a matter of looking at how do we change the underlying dynamics of the market system and the incentives that are present for providers, or for policymakers, or for consumers at each level of the economy. And where do we see that done effectively? Just to give one example, is the Mobile Money for the Poor program that is implemented by UNCDF in a host of countries. They really take a strategic approach that is ecosystem oriented, that focuses on uncovering the issues on the demand side that many providers and others on the supply side are not aware of in terms of financial services that do not meet the needs of those people. They work with policymakers and regulators on public good research and fostering dialogue among actors in the system that do not necessarily interact. And then also just a note on another relevant initiative on that point. In India, USAID is a significant partnership with the government of India and with, I think, over 40 now private sector partners, many banks, MFIs, technology firms, with the purpose of growing a vibrant merchant acceptance payment network through digital channels. It sounds like a very narrowly oriented partnership, but the whole idea there is how do we work with policymakers, with innovators, with banks and financial institutions to develop services that actually are useful to consumers and useful to merchants. Because if there's no utility in a digital financial service in this case, they will not necessarily see the value in adopting it. And if they do not adopt it, then there's not as much of a business case for the private sector to invest in the growth of that ecosystem. And then number two, the graduation model. CGAP and IPA, they've recently published a lot of research with the support of the Ford Foundation on how a multidisciplinary approach to giving people a pathway out of extreme poverty can actually yield a lot of benefits. Some of the research that they published showed significant improvements in consumption, in savings, in perceived economic opportunity and economic mobility. That suggests that there may be ways to, through a big push over 24 to 36 months, where you combine a mix of consumption support, financial capability training, mentoring, those sorts of initiatives, you're able to actually provide a positive step change in what is possible in someone's life. Next slide. So with that, I'll hand it back to Tim and look forward to the discussion.
Great, thanks, Paul. So Paul provided, I think, an excellent overview about where we are in terms of financial inclusion and what are some of the trends that USAID is following. And I think we'll touch upon some of these in our next three presentations, where we're dealing with some of these partnership issues or digital, enabling environment, and potentially some other methodologies. So I'd like to begin today with a picture or profile of one of the people we're trying to serve. This is a young person named Ibrahim. He lives in a rural village in Upper Egypt. And he's just beginning his economic life. He's graduated from secondary school, he's done his military service, he's ready to go. He works on his family farm, and he runs a small business on the side selling fodder for livestock. He has some assets, but he doesn't trust local banks, and so he keeps his money at his home, and he doesn't use any formal financial services. So, the question that we have for many of us is, how do we serve Ibrahim? How do we serve people in this transition point? Do we focus on them exclusively with a range of services, potentially using a graduation approach or something similar that Paul mentioned? Or do we target them as part of a broad-based strategy, but potentially risk losing sight of them in a larger overall initiative? Or do we ignore them, saying, well, youth just aren't worth it. Let's focus on adults until we can get things right, and then youth will come later on. It's to these questions that we tried to answer through the Rural Youth Economic Empowerment Program. This is a 3-year initiative that Making Sense recently completed. It was funded by the International Fund for Agricultural Development and Silitech. And it worked in 4 countries, implementing 5 pilot activities. We were testing 5 different approaches to financial and non-financial services that could serve to sustainably serve young people over the long term. We looked at a savings-led approach from a postal bank in Morocco, a savings group approach in Egypt, a microfinance institution providing startup credit to young entrepreneurs in Tunisia, a microfinance bank in Yemen providing a range of savings and credit services to young people, and then finally, a mobile-enabled supply chain app that was providing both a service to retailers as well as access to credit. Project was successful in terms of meeting its targets, and we reached over 20,000 youth during the 3-year time period, but it was short. But I believe that we learned a lot during this program, and I want to share with you some of our higher level learning. There were 6 case studies that were produced, and I invite you to kind of learn more about each of the pilots in those case studies, but I want to highlight some of the key things we pulled from all the projects today. So the first learning in terms of asking that question, what's the best strategy for serving youth? And of course, it will depend on the context, but I think what we found is that the pathway to rural youth is through adults. And that the most sustainable way to provide and sustain financial services to a rural youth population is by perfecting your products for the older population. Now, this isn't to say that we go to the youth last and that we wait until we serve youth before we serve young people, but that instead they should be part of an overall viable strategy. But we've seen that young, economically active young people in that age of kind of that 23 to 30 can be served with just a few tweaks of an adult-focused portfolio. You should set aside staff and have your specific targets and youth adaptation for that product. But those economically active youth can be served effectively as part of a larger strategy. The graphic tries to get at this in terms of recognizing that as the circle of your market that you're serving grows, it's naturally going to serve more adults, more rural adults before you get to rural youth. Now, it does indicate an alternative pathway to serving rural youth, which might be through a particular financial product that focuses on urban populations first, meaning that those are generally easier to serve, higher educated, closer to markets. But that pathway to rural youth should go through urban youth otherwise. And so that's one of our findings. Look at youth as part of an integrated strategy, get that adult portfolio right simultaneously as you're focusing on young people. A second learning that came from the project was focused on that kind of core segment of young people, that 18 to 24. These are our youth that are really just beginning their economic life. They're going through transition stages. They're inexperienced, they're vulnerable, and for those young people, we found that as we build assets, we also want to be building capacity. And I think we had a great example with Plan International in Egypt, where we designed a youth savings group methodology that provided savings and credit services to young people at the same time as it provided education. And so the project served 10,000 young people during the pilot phase. We're expanding it to 80, 100,000 now. But I think the impacts indicated that really was a change in knowledge that was as powerful as the increase in assets. And young people reported that they preferred the educational component or thought it was equal, if not more valuable, than the savings and credit activities. Now, of course, as we look at older youth kind of going into that more economically active 25 to 30 stage, the capacity building may not be as important, but in many contexts, it's still critical to success, especially when we're looking at startups. A third point is looking at adaptations for both rural and youth contexts. Our partner in Morocco, Alta Bates Bank, is a large postal savings bank. And so they wanted to pilot a new savings product for young people that basically brought them outside of the bank branch and but to the bank through an ATM. And they provided free debit cards along with a savings account. And this was their way to try and reach rural populations. They coupled this program with kind of a slick marketing campaign. You can see kind of an image of it here, where you had young people talking about their financial lives. There was a financial education component that was offered through the internet. And it was their way of getting at youth. And it was successful at a national level in terms of reaching a large segment of youth. They signed up 100,000 young people in about 2 months. And they were seeing broad nationwide expansion. Next slide. However, in rural areas, you can see by this graph, they were kind of creaming the crop. If you look at the education levels, they were really only getting the higher educated rural youth population. And so although they kind of met their target, which is relatively wasn't particularly ambitious, they recognized that if they were really going to expand to rural young people, they needed to make some changes. And they found when they did their analysis that the marketing campaign that was so slick and kind of youth hip and friendly for that urban environment, it would appeal to a middle class youth segment and not to a rural youth segment. And as well, even with the ATMs that were more convenient for young people, the bank branches were still too far away for many youth to access. And so they made some changes, recognized that perhaps mobile branches was going to be one way to increase the number of access points. It was also a way to conveniently provide some financial literacy education. And they changed their marketing, moving away from this kind of slick campaign, internet focus, which many young people didn't have access to using bank branch staff themselves who were trusted in the community and who young people naturally went to for student payments, for social payments, and that was a better entree to accessing savings. So for Alta Bates, the adaptation of both to the rural context and the youth context was critical to their success. Next slide. The third point I want to point out, and Paul mentioned it in terms of looking at that ecosystem of actors, critically important in rural areas, but also difficult to put together. In our case in Yemen, we worked with Al-Amal Microfinance Bank. Al-Amal is kind of a full-service bank that provides savings and credit services, and with them we designed a rural expansion strategy that looked at adults and young people at the same time, and engaged a number of partners to reach their objectives. And so they engaged partners on both the financial as well as on the non-financial service side. On the financial service side, they use exchange offices and then wholesalers to deliver their Islamic credit products. And that helped them to expand their geographic scope of the project. And then on the non-financial side, they engaged local NGOs to kind of give them access to these rural communities where distrust in an urban-based institution was high, and also to provide financial literacy and technical training. It was a challenging program to put together involving all these different actors. But for Al-Amal, it was very successful, and the rural population went from being 10% of their portfolio to a third in the 3 years. And so now they serve around 25,000 young people. 25,000 rural, of which 35% are young. So they were able to keep the adult-urban mix equal as they expanded. The last point I want to raise is in terms of a technology assisted solution. In Tunisia, we worked with a consulting firm called ProInvest, and they were looking at the rural retail market. And there, they developed a goods ordering system that you could order through your mobile phone, and that basically cut out the middleman, made it more efficient and less costly for young people, well, retailers in general, but with a focus on youth, to order their goods. And then also by digitizing the transactions, it provided a credit history that could be parlayed to increase access to credit from a local MFI. And so using the mobile phone, they were able to both make a more efficient goods ordering as well as to expand access to credit. That's still in the pilot phase, but it has attracted private sector investment, and a new company has been formed to take this product forward. So I want to leave it there with those kind of 5 lessons. We look at target young people as part of a rural expansion strategy simultaneously. Build capacity while you build assets. Exploit technologies when they're there to lower costs. Use partners effectively. And then also adapt for both that rural and youth context are kind of 5 key learnings that we want to leave with you here at the high level. And you're welcome to learn more about each of these cases through the 6 publications that came out and are available on our website. So I'm going to leave it there with those 5 lessons, and I'm going to turn the stage over to Sarah Mattingly. Sarah is the Senior Workforce and Youth Economic Opportunity Development Specialist at RTI International and is the back office project manager for the KES project. She's going to talk about some of their experience in Kenya. Sarah.
Is it okay if I just sit here?
As you like.
Okay, great. Actually, I'm going to move up here so I can see
Move around.
Anna.
Take the whole stage.
Great. Hi, everyone. Thanks, everyone, for coming. As Tim mentioned, I am the RTI staff member working on KES, which stands for Kenya Youth Employment and Services. It's under the Youth Power IDIQ and funded by USAID. Next slide. Great. So it's just an overview. We are working in 9 different counties. It's a phased approach. The first 2.5 years, we work in 5 counties. So the darker yellow. And then in the second phase, which is another 2.5 years, we're working in the light yellow. So you can see it's very dispersed geographically. There's a lot of different types, profiles of youth. So this has kind of created an interesting way to learn. We're doing a lot of different pilots, hoping to take the learning from the first phase to the second phase. The goal of the project is really employment, both wage and self-employment, and improved employment. The interesting piece of this, and I'll give you a spoiler, digital finance had not been central to our approach, to our strategy. We'd hoped it would be, we thought it would be, but it's proven not to be. Why? Mostly because the youth that we're working with, who are those who've not graduated from secondary school, do not have personal access to mobile. Mostly they're sharing it with a family member, sharing it with friends. So the idea of digital finance is not something that fits well in their lives. It's not safe, it's not convenient. So that's the spoiler. The approach that we're taking is really building systems. We're looking at it as a pathway that youth take to employment. Usually it's a mix of wage and self-employment, and we have certain entryways. We're coupling both skill building, technical and financial skill building, with access to finance, with information, and with linkages to employment and work-based experience. We have 5 main objectives. I've highlighted the one that's probably most interesting to this group. But as you can see, the way USAID envisioned this, it was really intended to be a systems approach. Next, please. I've posted a couple of our achievements for the year. We're in our first year. We started last year. It's a 5-year program, like I said. I think this is the one that's really relevant here, that in this first year, we've been able to reach 2,000 youth with access to finance. Next slide. Not going to spend a lot of time on this, but again, re-emphasizing that there really is an integrative approach that is taking all of those objectives to build a system that will help youth of different locations, different types, different education levels to reach those outcomes of employment. Okay. So I want to talk a bit about the context. I told you when we started up, we had one vision for our financial access piece, digital. We've since learned, because of a lot of these different reasons, that it's not the way to start. These youth we're working with 18 to 35-year-olds. They have not completed secondary school. And this is very relevant to Kenya because this is actually 68% of the workforce. 68% of Kenya's youth workforce they're not considered educated, meaning that they've completed secondary school. As a result, there was lower literacy and numeracy rates than we anticipated. The population is primarily rural. Because of the geographic coverage, we can't really focus on any one type of intervention. Mobile usage and internet usage is very low, and a lot of the implementing partners that we're working with lack resources. Our primary implementing partners are vocational technical centers. These are locally called youth polytechnics. They are kind of the bottom of the barrel of the vocational system, under-resourced. You know, some of these, I wish I had some pictures of them, but they're lacking computers. If they're teaching things like hairdressing, they don't have water. They might not have hair dryers. So these are really under-resourced implementing partners. So those are really the challenges we saw. On the other side of it, there were some opportunities that impacted our strategy. First of all, we're building on a previous USAID project called Yes Youth Can. It was a 5-year project really focused on giving youth a voice and helping them to organize. The key outcome of that was a creation of a system of youth governance, I won't say cells, groups called bunges, which means parliament. So there are over, I believe it's 9,000, we're working with, I think it's like 90,000 youth, 40,000, sorry, that are connected through these county level bunges. So we had this great resource to mobilize and engage youth. These bunges were primarily youth that did have secondary education. So they weren't our target, but they were a very good mobilization outreach strategy as well as training partner. And then the other thing that came out of Yes Youth Can that really guided our approach was the creation of youth SACCOs. In each of the counties that were covered by Yes Youth Can, which are all of ours, there was a creation of a savings and credit cooperative. So now that you kind of have a sense of the context, I'm going to break it into kind of the 3 key pieces that shape or are the ingredients for our financial access approach. First of all is mobilization, skills building, meaning both technical skills as well as financial literacy, access to finance, those skills that help them be prepared to access finance. And then the last one in our strategy is really linking them to the financial services. So on this slide gives you a bit more information about how we're mobilizing youth. We've really taken it to the village level. That's where we're finding the youth that we're intended to target, and it's proven to be the most cost-effective way. And we looked into SMS, we've researched all sorts of channels to build the awareness of youth about the employment opportunity or skills building and access to finance that we were creating, but they weren't getting there. So what we've done is we've engaged the Bunge members, who remember our youth, aged 18 to 35, who do have secondary education, trained them to do the mobilization and basic training. They're doing a lot of work readiness. They're doing a lot of trainings on financial literacy, and they're doing some very basic introductory business skills. The second thing that's really supporting our effort to mobilize is I call it a complementary activity that we're doing under the project. USAID in Yes Youth Can invested a lot of money in helping youth get national IDs. This is important in order to be able to start a business, access finance. So we've been continuing the precedent started by Yes Youth Can and holding at the village level outreach registration weekends. So it'll be on different days. We are partnering with the Registration Bureau at the national government level to register youth. We've so far registered over 40,000 in 1 year, but the great thing about this is we're using this to inform youth about upcoming skills training, upcoming financial awareness training. And in some cases, they're actually holding the trainings in parallel to the registration efforts. And I think just to reflect back on the pilots, this really speaks to the need to have face-to-face. We're doing it at the village level and using trusted counterparts, trusted implementing institutions. Next slide. So when we move on to the actual skills building, we're doing a lot of technical skills through the vocational training centers, as well as through local village level implementing partners who are doing business skills training, entrepreneurship training. But outside of that, as I mentioned, literacy and numeracy are really an issue. So it wasn't exactly in our scope, but what we're doing is working with the Kenya Department of Adult Education to improve and expand the reach of the mandated trainings for literacy and numeracy. So that's one entry place. And while we're doing that, of course, we're informing them of other opportunities offered by the project. The next one is financial literacy. So this is incorporated across the entire project, whether it's the vocational or whether it's the business skills. All the implementing partners have some level of literacy, financial literacy in their projects, in their courses. In fact, we're working at the moment to take it out away from being a separate component to be integrated into the actual skills training. So that's something we're hoping to roll out in the next phase. We have 2 different trainings. These are being implemented. They're created by IRC, International Rescue Committee, and they've been adapted specifically to the context of KS. Learn to Earn, which is intended to be low to moderate literate levels, and then their economic social curriculum, which is called EASE, and that works with illiterate youth. Okay, so I'll wrap this up. Finally, can we go to the next? Let's skip forward to 2. The main way we're reaching youth with financial services is VSLAs. Next slide. Village Saving and Loan. We've trained the Bongay youth to deliver financial literacy, which includes training on how to organize a VSLA. The youth are then organizing. I think most of you are probably familiar with how these work, so I won't go into too much detail. I think the interesting thing that we're trying to do is connect these VSLAs, which are proving to be undercapitalized, even with member savings, to larger umbrella VSLA groups. So there's several in Kenya that we're discussing how we can provide additional capitalization. Next. Similarly, we're working with the existing SACOs that were created by Yes Youth Can to expand their membership beyond the scope of Yes Youth Can to those youth who do not have secondary education. We're also working to build their capacity, and we're also working to help them get capitalization. This is a bit of an easier sale. We're working with MFIs who are interested in providing capitalization. We've developed some linkages to different financial institutions, both MFIs and commercial financial institutions. in some cases, youth that have graduated either from the VSLA or from the SACOs are able to access individual loans through microfinance institutions, which have been facilitated, introductions have been facilitated by the local village level trainers. We also have a larger partnership with Kenya Commercial Bank. They're partnering with us to package our training on agribusiness skills with patient capital, startup capital, improved access to inputs and access to markets so that the youth have guaranteed markets for the production. So last, to come to the final slide, how am I doing? Digital finance. So as I said, that was our dream. That's what we intended. There's a great digital financial product in Kenya called Mshwari. It's a savings product. We intended to teach every youth about it and have huge numbers. It hasn't worked out that way. We haven't given up though. We're looking at different ways we can link the VSLAs, ways we can try to introduce more youth through the SACOs. And then we're also going to, as we start building a foundation of youth who are financially literate, introducing them to different products. So now I'm going to turn it over to Allison. Allison is the former CEO of Finca Nigeria. She is currently working on business development for Finca, and she's going to tell you a bit about their work.
Good morning, everyone, and Happy New Year to you all. As you mentioned, I'm Alta Bates, and I work with Finca International, and Finca is fairly well known. By way of background, we're a global nonprofit organization that's focused on poverty alleviation, and we seek to help people create jobs, build assets, and raise their standard of living. And Finca's programs include social enterprise and some new areas, but our main program area is in microfinance and financial inclusion, which now spans 21 countries across Africa, Latin America, and the Caribbean, the Middle East, and South Asia, as well as Eurasia, and reaches 1.6 million clients today. You can go ahead and go forward, please. And we can go forward one more slide, actually. So here's a look at, you've heard a little bit about the geographical diversity of Finca's outreach, but here's a look at the diversity of Finca's clients in general. The approach that Finca takes is one that's inclusive and really looking to unlock the potential for all people, whether they're women or men, whether they live in urban areas or rural areas, and that also includes youth and also adults. And the way that we do this is by focusing on the simplest and most effective ways of scaling up and offering financial services that overcome the common challenges of unbanked populations or people who face barriers to financial access. And I know this because it colors how we will talk about our orientation to rural financial services and youth financial services, which may be different from other organizations who are more focused geographically or more focused on specific demographics. Go ahead, please. So, of course, the world's youth population is one that cannot be ignored, and it's the largest in the history of the world. But youth, as I think has come out of the earlier conversations, is a very broad category, and it deserves to have a little bit more segmentation and attention to the specific needs and challenges of a 10-year-old in primary school versus the needs and challenges of someone who is of a working age and 24 years old. So we don't want to talk about this as such a homogenous group, and the way that Finca approaches it is to break that market segment down further. But looking at it from the perspective of an institution like Finca, and at the industry level as well, we really want to consider what can be done to address the need for financial services for youth, given our limited resources and capacities and assets, and also how do we balance that against the investment that needs to be made in closing the gap on financial access overall, including for adults, while addressing this coming demographic need of youth who are not yet economically active, but will be in the next 5 to 10 years. And I think the primary way we have been looking at creating opportunities for youth has been, as Tim was also mentioning, through serving the adult population. And to add to what Tim said before about using the inroads that we make to serve the broad market segments and adults in general, the way that Finca looks at our impact on youth is inclusive of how adults then invest in the children that live in their families. And for us at Finca, we found that our clients have 2 to 3 children in their families, and our clients have told us in our client research how much they invest in their health and education in the youth. So it is a secondary level of impact, but it's one that we should definitely recognize as part of the overall framework. But there is a need for inclusive design and products that can be directly provided to youth, especially working-aged youth. And in addition to that, we want to look at what barriers we need to address with specific products designed for youth, especially children or those who are not yet 18 years old or who face particular barriers in their financial education and access. You can go ahead, please. So I want to talk specifically about some of the work that Finca has done on savings for youth in DRC and Uganda, and then to leave plenty of time, I hope, for questions and answers for all the panelists. So a journey of 1,000 miles begins with one step, and one of our first steps was in Uganda to introduce products called a junior account and then other products related to school fees. Now, these products were offered to adults for the benefit of their children, starting in about 2005, 2006. 2009 was really the first time that Finca Uganda and Finca as a network introduced a product that was specifically focused on youth. So that gives us the benefit of having many years to look back on and see how we've evolved. And I hope to kind of outline how that has moved forward for us. So this started with a Star Girl account in Uganda, which was focused on girls between the age of 10 and 19 who had already left school or were not enrolled in school for a variety of reasons. This product included financial education and also education on reproductive health. And it was piloted in two rural environments and 2 urban environments with some really important learnings for us. The overall scope, basically, it reached 2,000 girls over the 2-year period. So it was not tremendous in terms of scale, but this was one of our first steps on our long journey, and it taught us a lot about how to provide financial products and how to pay attention to the delivery channel element in financial services for youth and financial services in general. So again, this is back in 2009, 2010, and 2011, when Finca did not yet really have delivery channels that went beyond the branch network. And this was our opportunity to test new technology, and it was the first use of POS devices for delivery channels in Finca, because we found that Finca has a policy where we do not want to manage cash transactions outside of the branch network. So it was with this internal constraint that we came up with the idea of bringing out POS devices to the schools and the places where these girls groups were meeting and where transactions were taking place, and made somewhat costly investments in purchasing and providing these devices so these girls could make transactions then and there without having to go to the branch. And at the same time, so that Finca could learn how it can better use technology in general, whether it's for urban or rural youth, or whether it's for expanding our outreach into rural areas. So this evolved to move beyond girls, because actually, interestingly, we found that the financial education elements were very appealing to boys as well, to the point where young boys were putting on girls' clothing so they could attend some of these educational meetings. It's a very good signal that there was demand. So in 2000, after the end of the Star Girl program, we looked again at expanding this to include boys and girls, and the Smart Start account was created to address the need for savings from youth between the ages of 12 and 24, and adding to the use of POS devices and financial education, and many of the other lessons from the Star Girl. We also introduced use of ATM cards and access to ATMs throughout Uganda for an additional delivery channel. At the same time that we were launching this new account in Uganda, we were taking these lessons to DR Congo as well. And they launched 2 new account types, also focused on ages 12 to 24. And one of them was a fixed deposit account, and the other was a general savings account. And similarly to Uganda, the DRC experience really relied very heavily on technology. When the product first launched, there was a lot of effort on marketing, but the basic process was to go to the school, to gain interest from the student. The student would sign up for the account, but then you had to go and find the parent separately, have the parent sign up for the account, go back to the school, collect the dollar, go back to the branch, deposit the dollar, come back with a receipt. This obviously does not work for very long, and it does not work at any kind of large scale. So this was simultaneous with the time that we were deploying agency banking in Finca, DRC, using small businesses in the local area. So we specifically targeted agents that were located immediately next to schools and worked with the agents so that they understood how to serve the students in that school and how to promote, these savings products and other products within their local communities. And we saw that the uptake in enrollment had expanded by 5 times what was experienced in the previous year, because we could enroll students right then and there at their local agent and use that as an opportunity as in your projects as well to do community outreach and education, talk about products and services, and go beyond just the process of enrollment to really engaging people. And the end result was, in Uganda, we have 25,000 students enrolled in these youth product lines, and though they began in 2009, they continue today, and a similar number in DRC. And interestingly, we found that the average savings amount was about $12 and $13 in both countries, which I think we can take as a lesson on how much savings can be mobilized from this youth group from 12 to 24. And also it points to the challenge of sustainability of these types of products. We can go on to the next slide, please, which is my last. And some of our key takeaways. So in total, we've mobilized about $700,000 in savings from these youth products in DRC and Congo. But the benefits that savings brings in terms of reducing our cost of borrowing does not cover the cost of providing the financial literacy training or having staff who are specifically in place to reach out to youth. So this is a challenge that all financial institutions face. And in the case of Finca DRC and Finca Uganda, we decided to massively scale back the work that we were going to be doing on financial education due to the limitation in those resources. And instead of applying those resources for financial education, we wanted to apply them towards technology and reducing our overall cost structure by making investments in financial technology and growing at scale. But of course, the other key takeaways, again, youth are not homogenous. We do need distinct product lines and an integrated approach, which includes scaling up financial services generally in a way that's inclusive for youth, as well as identifying where we do need specific products or interventions. And that we can, in fact, still continue to have progress on financial inclusion for youth with youth savings, even when there's not a specific intervention for financial education or very specific set of staff who are working on this endeavor. And finally, I think for FINCA, the most important lesson and the one that we're really moving forward with is that if we can lower the cost of delivery overall and increase the scale overall, this is going to be the most powerful pathway for us to reach rural areas and expand our outreach to youth and to rural communities. And with that, I think I'll turn it back to you, Tim. Okay, great.
Well, so I think recognizing time, I think we'll try to get as many questions as we can in, and a mix from the audience as well as a couple from online. And I'll start first with you, Tim, talking about the pilots there. One specific comment, the slide about Alta Bates Bank in Morocco, it's striking that there was the product attributes for that savings account with the free debit card weren't necessarily highlighted as not reflecting what the rural youth would want, but the marketing plan, the outreach strategy just didn't reflect what they would have been responsive to, which makes me think, are there things that are more a matter of outreach strategy targeting youth versus product attributes targeting youth as the first point of entry? And then also the other point, there's the general, I think, objective and challenge that people face of outreach and also product attributes not responsive to what rural communities generally need, not just youth in particular. But asking about the 5 pilots across 4 countries in the Middle East and North Africa, what are some of the universal insights? Since these are pilots in particular cultures, how can we extend them to other countries and regions?
Sure. So let's see, I mean, I chose these lessons in part because I think they are largely universal. And so making sense, we work globally in Africa, Middle East, Latin America, Central Asia. And, you know, I chose those, and I think they are ones you see in any rural environment. I think what makes the Middle East distinctive is the Islamic nature of the products you have to offer in many places. And because of the mix of commercial and Islamic products, it is more challenging in rural areas where there's going to be more distrust of urban, modern mores. And so you have to get over that additional barrier when you're providing your products in those rural areas, and that trust is lower. But another point you raised in terms of looking at the mix of products, it is very context specific. In some places, you can take largely an adult-focused product and just market it and provide additional financial education for young people and get access. In others, there's additional layers of barriers that your particular segment, which Allison pointed out, will help them to access that particular product. And it could be it's the additional identification, it could be in terms of mobility, it could be in terms of just understanding what the product is. So I think it really is context specific what the challenge is, where in some cases you may need a very specific youth project with additional capacity building, and others more of a marketing and just general education that the product is there.
And then Allison, just a question on FINCA is both a provider of financial education, financial capability services to communities they serve, but also a financial service provider. But there are still clear needs for partnership. And so what are some lessons learned, I think, for you guys, either partnering with technology providers or partnering with local institutions where you may have less of a physical presence that you've learned to do so effectively?
Yeah, that's a great question. And it also varies country to country and project to project. But in general, we have found that there's a lot more success in financial education when it's done internally and in-house and integrated with the products that we're offering. The cost in general is lower, and it's a lot more of an efficient system where we can tie in the various stages of the product offering or account opening with the financial education more directly and make it very tight and cohesive. When it comes to integrating new technologies and getting into digital financial services, partnership is completely necessary. And it tends to take quite a lot of time to find the right partners to begin with who have the capacity and willingness to join you in a journey, and then also to work through the many technical issues that go beyond just the technology itself, but working with regulators and working with potentially a coalition of partners that may include MNOs and others. So I would say that patience is a very big part of that process. Clarity of vision and making sure that you understand what the motivations are for each of the actors before you start working together, and you make your motivations and interests very clear as well as a basis of a solid partnership. And most of these partnerships in technology require a significant capital expenditure to make possible and to continue to implement as you go along. So finding sources of capital and funding that are patient and understanding of the process of discovery and the process of innovation is also an important part of that.
I think a related question to that would be the sustainability one, and this is maybe something to bring through a couple other responses. But how do you? I was reading a CGAP blog post by a company in a microfinance institution in Ethiopia that is facing the same question. They've developed an effective youth savings product, but they haven't yet thought that much about handing it off, or as these youth grow and have more complicated, more sophisticated financial needs, how do you have something ready for them? And is it you, that same provider, that offers it to them, or does it require a partnership with another firm? Shifting, Sarah, to you, and this is again on the partnerships aspect. There was a question online about how do you, if one of your objectives is to work with the local infrastructure, the local community as much as possible, leveraging their resources and knowledge, what do you do when some of your soccer partners may have weak management capacity, which I think would be a common issue in many other places?
Sure, excuse me, that's a good question. Specifically on the SACOs, we are working with them to build the capacity of the management committees, both in terms of leadership, trying to help them, we're giving them grants to help build their infrastructure in order to be able to manage risk better, provide more leadership, and also product development. So we are not in the business as a project of developing our own products. What we want to do is encourage the SACOs as well as other implementing partners to identify the needs and design those products. So we have a grant window. That hasn't been launched yet in any type of partnership with specific institutions to develop those. The Kenya Commercial Bank came to us with this request to form a partnership, seeing that we had the capacity to mobilize. We had the outreach, we had the training on financial literacy and the capacity to raise awareness. What we're really looking for are those products that are appropriate. So working with them, we are developing those, or we're feeding into their product, their channels. And I think that's really the gap that we're finding. We don't have that as our objective to develop products. We want to link the youth to them, but there aren't the appropriate ones in the areas we're working with for this population without an ability to save significant amounts, nor with the financial literacy. So partnerships are essential, and we're finding a lot of them. It's just very complicated, and we're hoping with kind of a competitive, innovative grant process, we can get some ones that really, solve the problems, identify the problems, and then develop products for them.
Paul, if I could respond to your question in terms of, or the comment of the Ethiopian still is that question of the business case for youth financial services. It's still really a tough nut for us to crack. And there is a lot of interest and emphasis on youth financial services, and so a lot of pilots were started, and they often petered out after a while because they found it was expensive to provide the additional capacity building or to focus on a target market that was relatively marginal. And that's in part why some of our lessons, although in some respects obvious in terms of trying to expand rural financial inclusion broadly and not focus on young people in particular, is one response of looking at what the business case is. We know how difficult rural financial inclusion is, but so youth are not going to be that primary target market. But I think what we're trying to express as well is that we shouldn't lose sight of them, and if we can use those advances of whether it's technology or infrastructure to include them along with adults, that might be the best way to do it.
Perhaps focusing on their parents and looking at becoming a bank for the family with individual products, not just for their own.
And then I think the sophistication of a lot of financial institutions to be able to look at that picture over a time frame and say, if I do provide that kiddie account, and then to have a credit product for them when they reach college or school age, and then to have an entrepreneurship loan, it's not there with the majority of financial institutions we're working with in rural areas, and very few in urban areas as well. So it's a little bit of the institutional capacity isn't ready to digest or utilize that model effectively.
And then a question, this is really for any that can respond. The being able to, I think, better link financial education to the product delivery itself. So everyone, of course, financial capabilities is a popular topic these days versus what we've talked about more today about actual training and a fairly distinct separation between that and product usage. Are there lessons that you're learning either in the use of technology for FINCA and just partnerships with providers that have a better overlap between those two things?
Well, we're certainly looking at how we can use the technology that we're already bringing in place and new technologies to offer financial education through digital means or make it more readily available at a lower cost. Those opportunities are a little less available than we would like, but this is, if you can lower the cost of delivering those financial education modules, then this is something that can be both effective and used over time in a sustainable way. So using tablets, for example, to deliver our financial training to Village Bank members or to youth clients is something that we have piloted in the past and we want to look at more in the future as well.
Maybe just add to that question. I think financial education component is really an interesting one in that, again, there's a lot of initiatives like broad-based financial education, financial literacy. But I think what we know in this area is that unless it's demand-driven and given at a time when someone is ready to use it, that it's often ineffective. It just kind of stays out in the ether. And so I think one thing we're interested in, our savings group model would plan deliver the financial education at the same time as people were engaged in savings and credit activities. And that was a really effective way to get them to practice what they were learning at the same time. On the digital side, I think there's a lot of potential in terms of delivering financial education, the kind of the right amount and the right for the user in terms of what they're demanding at the right time through digital platforms, but I haven't seen a lot of examples there of them yet. We've experimented with MasterCard to develop kind of an overall financial education curriculum, but unlocking how that should be delivered and in units that are sufficient, because an SMS is typically too little, a tablet might be too much in terms of access. So I don't think we've solved that challenge yet. I think that's one that there's lots of potential, but we're not yet there.
A quick add-on. So again, we're not using technology, but the project is doing a lot of curriculum development. So one thing we're looking at is taking an approach that RTI has used domestically, which is called linked learning, and integrating both literacy and financial literacy into technical lessons. So the youth polytechnicals, I think we all agree that youth are doing not only many of these youth are not doing wage jobs. They don't have employers, and if they do, they also have a side business. So making that relevant to the technical thing they're learning, whether it's hairdressing or farming, has worked domestically. So we're starting a pilot to try that. It's still classroom teaching or farm field schools teaching, but how to integrate that.
one last question from online before we shift to the audience. Laura was asking about how do we promote a savings culture? Savings perhaps being the primary product that gets your feet wet and you understand how to begin to manage the money that you have as a young person, and then being able to grow into credit products over time. So in the course of your work, how do you, maybe I'll start with Allison, how do you do that?
Well, one of the barriers that I didn't describe in the presentation, but we did find in Uganda and DRC with our youth savings products is actually the savings culture barrier at the level of the parent. So that's something that when you're talking about youth and savings needs to be addressed as well. And in the case of Uganda, we actually started inviting the parents to come into the sessions where we were talking about financial education, because even the basic financial education we were offering to these students ages 12 to 24 was of interest to them and was new information to them, and helped them also feel more comfortable with working with FINCA. The second level of that is probably on the level of brand awareness and making sure that there's comfort in communities, with your organization as a steward of their resources. And then additionally, we found that most of the youth that we were working with already could identify some goals that they would like to save for, and where there were goals set and specifically set in writing, they tended to do better at meeting their commitments of savings. But again, I didn't know technology is kind of the main theme that keeps coming up again, but savings culture means building a savings practice, and to have a savings practice, it has to be convenient. And for it to be convenient, you have to have some sort of channel that's readily accessible. So that's an essential part of having a savings culture in place, is having a place where savings can happen.
And I would think over time, as digital, data-enabled digital credit products become more prevalent and more accessible for young people, then you'll face that same question: how do you promote responsible borrowing when it becomes that much more accessible, since you don't need as much collateral, if any collateral, necessarily for some of those products.
Well, maybe why don't we open up to the audience and go from there, and I give them a few moments.
So anyone that has a question, I'll walk around with the mic.
Chris Leonard from ISC. It's probably a question for everybody here. Tim, I heard you mention startup financing, entrepreneurship financing, and that's we tried it too in Lebanon and things. And it's a really tricky concept, because even here in the United States, most bankers would run away from startup financing. So how do you all address that in terms of, is it really true startups, or is it, a youth who's taking over kind of the family business, or is it someone who's kind of doing a side business and they want to expand? How do you all, because startups everywhere in the world, it's 50% or more failure rate. So how do you kind of make that work?
So it's hard, and I think let's see. There's a few different ways to approach it. I think a lot of the quote startup lending is in part for people already doing a business and expanding that, and that's perhaps most viable way to begin. In the least amount of kind of capacity building analysis needs to happen to make that product successful. A true startup where it's working through all business planning and kind of, do they have the right resources to make it happen, and then offering a loan on top of that. That's much more of a development activity, different from, I think, from the sustainable finance that a lot of us are trying to provide. So, different methodologies depending on who you're trying to serve. It's still very hard, and I think requires a lot of subsidy and support to make happen.
Any other questions from the left side, from the right side?
Yeah, I feel that World Partners for Development. Monitoring and evaluation is very important tool for projects, and you are dealing with financial programs and projects. How are you going about your monitoring and evaluation? Because most of the times I do programs in Africa, and you might see on the website of organizations, maybe we have done this, we have done that, in some of the big projects. If you go to the field, it's not like that. So I bring up your monitoring and evaluation too, for the people to benefit on the field.
Maybe to that, this market systems development also requires a different approach to M&E and being prepared to be a patient donor, and if you're partnering with a private sector actor, a patient private sector partner as well, but some of that relates to what they can expect in that given time frame.
Yeah, so on the question of M&E, especially as it relates to technology, it's an area that's evolving for us a bit as we're learning which metrics we want to be tracking over time and as we're building out our reporting databases and capacities. But we do set specific project targets and look at things like cost per transaction and tracking these kinds of measures over time alongside basic outreach measures. But beyond outreach, our monitoring and evaluation at Finca includes client-level research and understanding how our work is either aligned to or perhaps not aligned with our mission and can be better directed to reaching those who are unbanked, et cetera. So keeping us accountable to our mission and then understanding at the client level their level of satisfaction with our products and services or where there may be gaps that we still need to address. So I think we do have quite an integrated program, but one of the fun parts about data and information is it always leads to more questions. So we don't have all the answers to all questions, but we are seeking to improve how we manage our data so we can be better equipped.
One more, time for one more. I think that is a hand over here.
Hi, I'm Erin Rudiger from EDC. I just had a question for the KES project. With regard to the transitions from the YYC project to KES with the SACOs and the Bunges, I was just wondering kind of what state they were in when you guys entered, if there was overlap between the two projects and how much work it took on your end to kind of get in and start capacity building with the management structures and so on.
Sure, that's a relevant issue. I think so YYC covered, SU10 covered all the counties. So the 5 that we've started with, and the 4 we'll be working with, and actually are already started working with, we're all YYC counties. The big shift was changing the mentality of the Bunges, because the Bunges were youth that were not our target. They had secondary education. So shifting the mentality from being one of a recipient of project support to being an implementer. So they are implementing partners. We're giving them grants to do everything from the ID registration to the financial literacy training at the village level to becoming what we're calling community resource persons who do the engagement basic training, including the VSL training for the group savings. The SACOs, depending on the county, they varied in capacity. We have quite a mix, and that's why we're doing grants and specialized capacity building that fit the needs of the SACOs, including product development.
Great. Well, thank you, Sarah. Thank you all. I think we will use that question to conclude our webinar today. I want to thank everyone online for having the patience to stick around for an additional 25 minutes, and for all of you here in the room for engaging with us today. I think an evaluation will be sent out to everyone who's registered, and is that correct? And then this recording will be posted online, so please send it out to other people who weren't able to make it today. And I just want to thank our panelists, Paul, Sarah, and Allison, for providing their perspectives on financial inclusion and how we might extend this to rural youth. Thank you so much, and have a good day.